You've been told for most of your investing life that there is one correct answer: buy index funds. Buy the whole market. Don't try to pick stocks. Don't pay attention to the news. Let compounding do the work. It's the advice every personal finance book gives. It's the advice every financial advisor gives. It's the advice your smartest friend gave you the last time you asked them what to do with your savings. And for most of the last 40 years, it has been correct advice. But right now, in 2026, that advice is sitting on top of the largest concentration of money, voting power, and assumed certainty in the history of American finance: $13 trillion. $13 trillion sitting in index funds, all making the same bet on the same assumption with the same exit door. And almost nobody is asking what happens when the bet stops working. Stay with me, because I'm not going to tell you index funds are a scam. I own index funds. I'll probably keep owning them. What I'm going to do is walk you through three things about how index funds actually work that almost nobody talks about. And by the end of this video, you're going to understand why the most boring, safest, most universally recommended financial product in America might also be the biggest unexamined bet of your lifetime. Let me start with a number that should not be possible. In the year 2000, passive investing, meaning index funds and the ETFs that work like them, made up about 5% of the US stock market. Today, that number is over 50%. Half. Half of the entire US stock market is now owned by funds that buy stocks without anyone deciding which stocks to buy. I want you to sit with that for a second, because the implications of it are not obvious and they are not small. Here is what an index fund actually does. When you put $100 into an S&P 500 index fund, that fund takes your $100 and buys a tiny piece of every company in the index. But it doesn't buy equal pieces, it buys in proportion to the size of each company. If Apple is 7% of the index, $7 of your 100 goes to Apple. If a small company is 0.01% of the index, 1 cent of your 100 goes to that company. This is called market cap weighting, and it sounds neutral. It is not neutral. Here is what market cap weighting actually means in practice. When you put money into an index fund, you are buying the most of the companies that are already the biggest. You are giving the most of your money to the companies that need it the least. And critically, you are doing this without anyone asking whether those companies are actually worth what the market currently thinks they are worth. An index fund doesn't care what a company is worth. It cares what a company is priced at. Those are not the same thing. A company's price is what the last person paid for it. A company's worth is what its future cash flows will eventually justify. For most of the history of investing, the work of figuring out the difference between those two things, between price and worth, was the actual job of the market. Analysts dug through financial statements. Investors made bets on which companies were undervalued and which were overvalued. Money flowed toward the companies that deserved it and away from the companies that didn't. That work is what made the market function. When half of the market is index funds, half of the market has stopped doing that work. That work is what made the market function. So what happens to a market when half of it stops thinking? Here is what happens. Every dollar that flows into an index fund flows, mechanically, into the biggest companies in proportion to how big they already are. The bigger they are, the more money they get. The more money they get, the bigger they become. The bigger they become, the more money the next dollar gives them. This is a feedback loop, and it has nothing to do with whether the companies are good. I want you to picture something specific. It's the 15th of the month. Somewhere in America, a software engineer named, let's say, David, gets paid. David doesn't think about his 401k. Duh. He set it up 4 years ago and hasn't looked at it since. But on the 15th, automatically, 8% of his paycheck moves into his retirement account. And that money, the moment it lands, gets deployed. That not by David. David is in a meeting. David is making coffee. David is doing literally anything except thinking about his retirement account. The money gets deployed by software. The software buys the S&P 500. which means the software buys 7% Apple, 6% Microsoft, 6% Nvidia, and so on down the list. The software does not ask whether Apple is worth what it costs. The software does not ask whether Nvidia's valuation reflects reality. The software buys in proportion to size because that's what the software is built to do. The software does not ask whether Nvidia's valuation reflects reality. Now multiply David by 60 million Americans with 401ks. Multiply the 15th by every payday across every company in the country. Multiply the software by every retirement plan administrator in America. And what you have is a river of money flowing every 2 weeks mechanically into the largest companies in proportion to how large they already are. Now that explains a little. Nobody decides this happens. Nobody could stop it if they wanted to. It just happens, the way water flows downhill, because the system is built to make it happen. This is what economists call a momentum distortion. This is what economists call a momentum distortion. It's the same thing that happens in any market where buying is divorced from analysis. The thing being bought goes up because it's being bought, not because it's worth more. And the going up triggers more buying, which triggers more going up. Sound familiar? That's the same structural pattern that drove the dot-com bubble. The same pattern that drove the housing bubble in 2007. The same pattern that drove the crypto bubble in 2021. In every case, the buyer stopped asking what the thing was worth and started buying because the price was going up. Now, I want to be careful here. I'm not saying index funds are exactly the same as crypto in 2021. The companies inside the S&P 500 are real businesses. They make real products. They generate real cash flow. But the mechanism by which money is flowing into them, increasingly, has nothing to do with any of that. It's flowing in because David's paycheck hit on the 15th. It's flowing in because the software is built to deploy it. It's flowing in because every personal finance book ever written told 60 million Davids to flow it in. And that money is buying without analysis, in proportion to size, forever. There is a man named Michael Green who has been trying to warn people about this for almost a decade. Green is a portfolio manager. He has spent his career analyzing companies. He runs real money for real clients. And he tells a story about walking into his office a few years ago and realizing something that, once he saw it, he could not unsee. The story goes like this. Green is looking at the price of a stock he covers. The price has gone up. He wants to understand why. So he does what analysts do. He looks at the company's earnings. The earnings have not changed. He looks at the company's guidance. The guidance has not changed. He looks at the analyst reports. Nothing material has changed. Then he looks at the flows. And he sees that on the day the stock went up, an index fund bought it. Not because anyone at the index fund thought the stock was a good buy, but because money had flowed into the fund and the fund's rules required it to buy. Green's realization, the one he could not unsee, was this. The price of the stock had been set, that day, by people who were not analyzing anything. The price had been set by software responding to flows, and once Green saw that, he started seeing it everywhere. Then, Green didn't say anything. He started noticing that the price of every stock he covered was being shaped, increasingly, not by what the company was doing, but by what the flows were doing. He started noticing that on days when index funds bought heavily, prices went up across the board, regardless of company-specific news. He started noticing that the link between a company's actual performance and a company's stock price was getting weaker every year. Green's argument, which he has been making in interviews and white papers for nearly a decade, is that the stock market has stopped being a price discovery mechanism. It has become a flow distribution mechanism. Money comes in, money gets allocated. Prices respond to the allocation, not to the companies. And here is the part of Green's argument that should make you sit up. The mechanism works in both directions. When money is flowing in, the system pushes prices up, mechanically, regardless of whether the companies deserve it. When money flows out, the system will push prices down, mechanically, regardless of whether the companies deserve it. And the demographic math on when money starts flowing out is not subtle. The baby boomers, the generation that did the most to build the trillions of dollars sitting in 401ks and IRAs, are now in their 60s and 70s. They are no longer contributing to those accounts. They are starting to withdraw from them. The next generation, the millennials, is contributing, but there are fewer of them. They earn less in real terms. They started contributing later, and they have less disposable income to put in. Did I just miss a chat? The math eventually flips. The river that has been flowing in for 40 years starts flowing out. And the same mechanism that pushed prices up mechanically in proportion to size starts pushing prices down mechanically in proportion to size. Now I want to show you the second thing about index funds that almost nobody talks about. When you buy an index fund, you don't own the stocks inside it. The fund owns them. You own a share of the fund. And the fund, not you, votes the shares at every shareholder meeting of every company in the index. 3 companies dominate the index fund industry: BlackRock, Vanguard, State Street. Together, those 3 companies are the largest shareholder in roughly 90% of the companies in the S&P 500. I want you to actually sit with what that means. 3 companies headquartered within a few hundred miles of each other, run by a small number of executives nobody elected, hold voting power over almost every public company in America. They decide which board members get appointed. They decide which executive compensation packages get approved. They decide which shareholder resolutions go forward and which die. When BlackRock decides that the companies in its funds should care about climate risk, those companies care about climate risk. When BlackRock decides they shouldn't, they don't. This is not a hypothetical. BlackRock has reversed its position on ESG voting twice in the last 5 years, and each time, voting patterns across hundreds of companies shifted to match. The underlying investors, the actual humans whose money is in those funds, are not consulted. You are not consulted. David is not consulted. David, somewhere in America, voted in BlackRock's CEO at the last shareholder meeting of 300 companies and didn't know he did it. This is a concentration of corporate power that has no precedent in American history, and it is the direct, mechanical consequence of the rise of index funds. When you tell 60 million people to passively own the market, you are also telling them to passively hand their voting power to 3 companies. Most of them don't know that's what they're doing. Now I'm going to tell you the third thing. And this is the one that if you take only one thing from this video, I want it to be this. You have been told that the stock market goes up over long enough time horizons. You have been told that even if there's a crash, you just have to wait and eventually the market recovers and your patient investment pays off. Your famer TV Taktebra. That belief is the foundation of every piece of buy and hold advice you have ever received. And that belief is based on a specific dataset. The dataset is the American stock market from 1926 to today. There is one country in modern history that ran the same experiment and got a different answer. That country is Japan. In December of 1989, the Japanese stock market reached an all-time high. The index was called the Nikkei 225. It hit a level of about 39,000. Japanese investors had been told the same thing American investors are told now: buy the market, hold forever, let compounding do the work. The market always recovers. I want you to imagine a specific person. Call her Hanako. Hanako is 40 years old in 1989. She has worked hard. She has saved diligently. In December, she takes her retirement savings and puts it into a fund that tracks the Nikkei. December. She is doing exactly what every responsible person in Japan is being told to do. She is buying the market. She is planning to hold forever. She is letting compounding do the work. The market crashes the next year. Hanako does what she's been told. She holds. The market keeps falling. Hanako holds. Her friends panic and sell. Hanako holds. The financial press tells her to be patient. Hanako holds. Hanako is 45. The market is still down. She holds. Hanako is 50. The market is still down. She holds. Hanako is 55. the market is still down. She holds. Hanako is 60. The market is still down. She holds. Hanako is 65, retirement age, and the market is still down. She holds because what else can she do? Hanako is 70. The market is still down. In February of 2024, 34 years after the peak, the Nikkei finally returned to its 1989 level. Hanako is 74 years old. Her money, in nominal terms, has just gotten back to where it started. In real terms, after inflation, she has lost 34 years. An entire working career. A child born the day Hanako bought that fund would have graduated college, started a career, gotten married, and had their own children before Hanako's investment got back to where it started. And here's the part that should chill you. Japan in 1989 was not some obviously broken market. It was the second largest economy in the world. It was the country every American business school told you to study. Its companies were buying American real estate, American film studios, American everything. Way after that, the advice in Japan in 1989 was the same advice you hear in America in 2026. Buy the index. Hold forever. Let compounding do the work. That advice destroyed a generation of Japanese savers. Now I want to be careful, because the easy version of this argument is to say the US is the next Japan, and that is not what I'm saying. The American economy is structurally different from the Japanese economy in important ways. What I am saying is this. The assumption that buy and hold the index forever is a universal law of nature is an assumption. It is not a law of nature. It worked for a specific country during a specific period under specific conditions. The conditions can change. So where does this leave us? See, let me say what I'm not saying, clearly, because the next thing I say will get quoted out of context by people who want to make me sound like a crank. I am not telling you to sell your index funds. I am not telling you to switch to active management. I am not telling you to time the market. I am not telling you that a crash is coming next year, or the year after, or ever on a timeline anyone can predict. What I am telling you is this. You have been handed a financial product marketed as the safest, most boring, most universally correct choice you can make. And underneath that marketing is a mechanism that nobody fully understands, controlled by three companies nobody elected, sitting on top of an assumption that one country in modern history has already proven can be wrong for 34 years. And sometimes it's just. That is not a reason to panic. It is a reason to think. So here's what thinking about it actually looks like. First, know what you own. If half your net worth is in S&P 500 index funds, you are not diversified. You are concentrated heavily in the largest American companies, with three voting blocks deciding what those companies do. That might still be the right choice for you, but know that it's a choice. Second, ask whether the people giving you investment advice are giving you advice that fits your situation or advice that fits the assumptions of the last 40 years. Those are not always the same advice. Third, pay attention to who is on the other side of the trade. For decades, when index funds were a small part of the market, they were free riders on the price discovery that active investors were doing. The active investors figured out what things were worth. The index funds bought in proportion to size. That worked because there were enough active investors to keep the prices honest. When half the market is index funds, there are not enough active investors left to keep the prices honest. The free riders have become the road. And fourth, and this is the one I want you to actually take with you. The question is not whether the stock market will go up over the next 40 years. The question is whether the mechanism you are using to put money into it can survive the moment when the people who built it start taking their money out. Because that moment is coming. Not next year, not next decade necessarily. But the demographic math is not a forecast. It's an arithmetic. The boomers are going to withdraw. The millennials are not going to deposit at the same rate. The river is going to slow. The river is going to slow. And the mechanism that pushed prices up in proportion to size, mechanically, for 40 years is going to push them down in proportion to size, mechanically, when the flow reverses. The companies that benefited most on the way up will be hurt the most on the way down. The investors who concentrated the most on the way up will be hurt the most on the way down. The advice that worked the best on the way up will fail the worst on the way down. I don't know when it happens. I don't think anyone does. But I know the structure is in place. I know $13 trillion is sitting in a single bet. I know 3 companies hold the voting power. I know one country has already lived through what happens when this kind of mechanism reverses. And I know that almost nobody is talking about any of this. That last part is the part that worries me the most. That last part is the part that worries me the most. Because in every financial crisis in modern history, the thing that caused the crisis was the thing everyone had agreed not to question. In 2007, it was housing prices. In 2000, it was internet valuations. In 1989, in Japan, it was the assumption that the market would always recover. In 2026, in America, it is the assumption that putting your money into an index fund is the obviously correct, obviously safe, obviously universal answer. It might still be the right answer for you, but it is not obvious, it is not safe in the way you've been told it's safe, and it is not universal. It is a bet, a $13 trillion bet. And the first step to being a thoughtful investor in any era is knowing what you're betting on. In the next video, I'm going to walk you through the specific moves I'm making with my own money in response to all of this. I'm not selling my index funds, but I'm doing 3 things alongside them that I think most people in my position should at least consider. One of those things is going to sound contrarian. Another is going to sound boring. The third one, most financial advisors will tell you not to do. Subscribe so you don't miss it. And in the comments, tell me what you own and why. If you think I'm wrong about any of this, tell me that too. I read the comments, I argue back. That's how this channel is going to work. The bet that nobody is questioning is the bet most worth questioning. That's true in every era. This one is no different.